Ever dreamed of your money working for you instead of the other way around? What if you could plant seeds today that grow into trees bearing the fruit of passive income for years to come? Sounds like a fantasy, right? But it's entirely within your reach. Hi there, I'm your trusted financial guide, and in this video, we're embarking on a transformative journey to discover 12 remarkable assets that can earn you money while you sleep, shop, or even as you binge watch your favorite Netflix series. Whether you're a seasoned investor looking to diversify or a novice just dipping your toes in the vast ocean of investment opportunities, this video is your treasure map to financial growth and freedom. Stay tuned till the end, and you'll be well equipped with knowledge, strategies, and the power to turn your financial dreams into reality. Ready to unlock the door to your prosperous future? Let's dive right in. You know, some people think that assets are just something the super rich talk about in their fancy yachts while sipping champagne. But let me tell you this, assets are everyone's business, yours and mine. In simple terms, an asset is something valuable that you own. It can be anything from your car, your home, or the diamond ring you inherited from your grandma. But when we talk about assets in the investing world, we're usually referring to things that can help us earn more money. We call them income-generating assets. Stocks, real estate, even that quirky collection of vintage action figures you've been hoarding since childhood can be assets. Oh, and by the way, your most valuable asset is knowledge. So let's power up that asset and dive into the exciting world of income-generating assets. Asset number 1, dividend stocks. A darling among many investors, dividend stocks are shares in a company that pay out a portion of their earnings to stockholders. Think of it as a thank you note from the company for investing in them. The beauty of this income generator lies in its twofold benefit. First, you earn dividends periodically, typically every quarter. Second, you can also enjoy potential capital appreciation if the company's stock price increases. Now there's a science to picking the right dividend stocks. Successful investors often look for companies with a history of steady dividend payouts, and these are usually well-established, profitable firms. But remember, with investing, there's always an element of risk. Even big companies can face downturns, impacting their stock prices and their ability to pay dividends. So it's crucial to diversify your dividend stock portfolio across different sectors. To support this point, a 2017 study published in the Journal of Financial Economics showed that diversification reduces risk and potentially increases returns. So remember, when it comes to dividend stocks, diversity is your ally. Moving on to asset number 2, bonds. Often considered the safe harbor in the tumultuous sea of investments, bonds are essentially loans you give to governments or corporations. In return, they promise to pay you back the principal amount with interest after a specified period, known as the bond's maturity date. This regular interest payment, or coupon, is your income. Now, you might wonder why anyone would prefer bonds when stocks can offer potentially higher returns. The answer lies in the relative stability of bonds. While stocks can oscillate wildly based on market conditions, bonds offer a more predictable and stable income stream. This stability makes them particularly attractive to risk-averse investors or those nearing retirement. To back up this point, according to a 2018 research paper from the National Bureau of Economic Research, individuals tend to shift towards safer assets like bonds as they age. Now for a trivia question, do you know what a bond with a very low risk of default is called? Leave your answers in the comments below, and let's continue our journey of income-generating assets. Fantastic! You're definitely on a roll here. So let's keep the momentum going and dive into our third asset, real estate investments. This is an exciting one. Real estate investments offer a tangible and versatile path to income generation. Owning a property can yield a steady stream of income if you decide to rent it out. Think about it. Every month without fail, you receive a check, all while your property potentially appreciates in value. Real estate investing can also provide tax advantages in some countries, which makes it even more attractive. But as alluring as it sounds, it's not just about purchasing a property and waiting for the cash to roll in. Successful real estate investing involves careful property selection, diligent management, and sometimes the willingness to get your hands dirty with renovations and repairs. This isn't a game of Monopoly. It's real life with real challenges. So always remember, in the realm of real estate, location is king, but knowledge is the power that rules the kingdom. Speaking of knowledge, did you know that according to a 2021 report from the National Association of Realtors, 89% of investors choose real estate for its potential for stable cash flow? If you are getting value from this video, then please like and subscribe to the channel. Thank you. Let's keep going. Now, asset number 4, we're entering the realm of modern finance. Peer-to-peer lending. Think of it as playing the bank, but in a friendly digital neighborhood. Peer-to-peer lending platforms connect individuals who need a loan with those willing to provide one, and that's where you come in. By lending your money to others through these platforms, you can earn interest, similar to how a bank profits from the loans it offers. But before you get too excited, remember that there's no such thing as a free lunch. Just like any other asset, peer-to-peer lending comes with its own risks. The biggest concern? Default. Borrowers might fail to repay their loans, leading to a loss of your investment. To mitigate this risk, it's important to diversify your loans across many borrowers. That way, even if one or two default, the interest you earn from the others can help cushion the blow. And here's a quick fact. According to a study by the Cleveland Federal Reserve, diversification across at least 100 notes can help significantly reduce the risk in peer-to-peer lending. Time for trivia. Do you know which country was the first to establish a peer-to-peer lending platform? Leave your answers in the comments and let's gear up for the next income-generating asset. Are you ready for asset number 5? Brace yourselves, it's time to talk about high-yield savings accounts. Yes, you heard me right, the good old savings account that we often overlook, dismissing it as boring and old-fashioned. Well, let me tell you, there's more to these accounts than meets the eye. High-yield savings accounts are just like your regular savings account, but with one crucial difference: they offer significantly higher interest rates. So while your money is as safe as it would be in a regular savings account, it's working much harder for you, growing steadily over time. And the best part, you still have access to your money whenever you need it. But there's a catch, isn't there always? These high yields can sometimes come with conditions like maintaining a certain minimum balance or limitations on the number of transactions you can make each month. Failure to meet these conditions might result in lower interest rates or additional fees, so always read the fine print before you dive in. Now that we have our feet firmly planted in the realm of safe and somewhat traditional income-generating assets, let's uncover the mysteries of asset number 6, certificates of deposit, popularly known as CDs. CDs are like the mature, disciplined cousin of savings accounts. When you buy a CD, you're effectively lending your money to the bank for a fixed term. It could be as short as a few months or as long as several years. In return, the bank pays you interest. At the end of the term, you get back your original investment plus the accumulated interest. CDs might not seem as glamorous as some of our earlier assets, but what they lack in razzle-dazzle, they make up for in safety and predictability. They offer higher interest rates than traditional savings accounts and are considered low risk because they are insured by the FDIC up to the maximum allowed by law. It's like having your cake and eating it too, with the bank playing the role of the trustworthy baker. However, in the world of finance, even the seemingly perfect baker might hide some less palatable ingredients. With CDs, the main drawback is their lack of liquidity. If you decide to withdraw your money before the end of the term, you'll likely face a penalty which could eat into your earned interest. It's crucial to consider this aspect before committing to a CD. Can you afford to lock away your funds for the entire term? Our 7th income-generating asset: real estate investment trusts, or REITs for short. With REITs, you could become a real estate tycoon without the hassle of managing properties or the need for massive upfront capital. Intrigued? Let me explain. REITs are companies that own or finance income-generating real estate across a range of property sectors. By investing in a REIT, you're essentially buying shares in a portfolio of properties. And the best part, REITs are required by law to distribute at least 90% of their taxable income to shareholders in the form of dividends. That means regular income for you, the investor. While the idea of investing in lucrative real estate markets may make your eyes light up, remember that not all that glitters is gold. Like any other asset, REITs come with their own set of risks. Market volatility, economic downturns, and property-specific issues can affect the income generated by REITs. So, as an investor, it's crucial to research and understand the specific REIT you're investing in, the properties it holds, and the sectors it operates within. Remember that knowledge and due diligence are your greatest allies in your financial journey. Continuing the journey, we move to asset number 8, royalties. Yes, we're talking about the type of cash flow that made Elvis Presley's estate worth more after his death than when he was alive. But you don't need to be a rock and roll star to earn from royalties. They exist in many industries such as mining, energy, technology, and more. So, what's a royalty? It's a payment made to the owner of a property, invention, or work of art in return for the right to use it. The owner earns a percentage of revenues or profits generated from their property without having to work for it. If you're thinking, hey, isn't that passive income? You hit the bullseye. But how can you, the investor, benefit from this? Well, some companies offer the opportunity to invest in royalties. By buying shares in these companies, you can earn a portion of the royalty income they generate. Here's an example from the oil industry. Oil royalty companies earn a percentage from every barrel of oil produced on their land. As an investor, you could buy shares in these companies, giving you a slice of their royalty income. But remember, with great potential rewards come risks. The income from royalties can fluctuate based on factors such as market demand, changes in technology, or even legal challenges. It's important to conduct a thorough analysis of the specific industry, the company, and the property generating the royalties before investing. Before we move on, let's test your knowledge with a trivia question. Can you guess the world's highest earning deceased celebrity in 2022, according to Forbes? Don't rush to Google. Leave your guess in the comments below, and we'll reveal the answer in the next video. Let's continue our journey into the world of income-generating assets. You've been doing great so far. Ready to dive into asset number 9? Here we go. We're talking about ETFs, short for exchange-traded funds. ETFs are investment funds traded on stock exchanges, much like individual stocks. They are designed to track the performance of a specific index, sector, commodity, or asset. What makes ETFs a great income-generating asset? Their unique combination of broad diversification and daily liquidity. ETFs can hold hundreds or even thousands of stocks or bonds, so when you buy shares of an ETF, you're essentially buying a piece of a vast portfolio. This can help you achieve a level of diversification that could be quite difficult and costly to replicate with individual stocks or bonds. Additionally, unlike mutual funds, which are priced at the end of the trading day, ETFs can be bought and sold at any time throughout the day, providing you with greater flexibility and control over your investment. That sounds pretty neat, right? But before you jump in, it's important to understand that, like any other investment, ETFs are not immune to risk. The value of an ETF can fluctuate based on the performance of the underlying assets it tracks. Therefore, a good understanding of these assets, along with a carefully planned investment strategy, is key when investing in ETFs. Here's a trivia question for you. Do you know which was the first ETF ever launched? Leave your answer in the comments. Next, we're going to explore asset number 10, mutual funds. Mutual funds are essentially a pool of funds collected from many investors for the purpose of investing in securities such as stocks, bonds, money market instruments, and similar assets. Managed by professional fund managers, these funds can provide diversification and potentially generate income through dividends and capital gains. Stay tuned to discover how mutual funds can add value to your financial portfolio. Brilliant. It's time to delve into asset number 10, mutual funds. Just imagine for a moment an expert team that takes your money, along with the money of other investors, and uses their expertise to invest it in a diverse array of securities. This is exactly what happens when you invest in a mutual fund. Your money gets to hitch a ride with the pros, giving you access to diversified investments that would be otherwise challenging or expensive to achieve individually. Mutual funds have the potential to generate income in two ways. First, through dividends paid out by the underlying securities in the fund's portfolio. These dividends can either be distributed to investors or reinvested back into the fund, increasing the value of your shares. Second, if the fund sells securities that have appreciated in value, you may receive a capital gains distribution. So by investing in mutual funds, you essentially get a share of the income generated by the fund's portfolio, all while benefiting from professional management and diversification. But it's not all sunshine and roses in the world of mutual funds. Like any investment, they come with inherent risks. The fund's value can fluctuate based on the performance of the underlying securities. There are also management fees to consider, which can eat into your returns. Additionally, unlike ETFs, mutual funds can only be bought or sold at the end of the trading day, meaning you can't take advantage of intraday price fluctuations. Therefore, while mutual funds can be a great way to generate income and diversify your portfolio, it's crucial to understand the specific fund, its investment strategy, and fee structure before investing. Now, on to the 11th asset, annuities. Annuities are essentially contracts between you and an insurance company where you make a lump sum payment or series of payments. In return, the insurer agrees to make periodic payments to you, either starting immediately or at some future date. This can provide a steady stream of income during retirement, making it a popular choice among those planning for their golden years. The two main types of annuities are immediate and deferred. Immediate annuities start paying out right after you make your initial investment, while deferred annuities accumulate earnings for a specified period before they start making payouts. This allows your investment to grow tax-deferred until it is time to receive payouts. The payments can last for a certain period or extend over your lifetime, providing a steady, reliable income stream. It's almost like having a personal pension plan. However, annuities are not without their pitfalls. They can be complex products with potentially high costs, surrender charges, and tax penalties for early withdrawal. Additionally, your payouts might not keep up with inflation, which could decrease your purchasing power over time. Therefore, it's critical to read the fine print, understand the terms and conditions, and consider seeking professional financial advice before investing in annuities. Speaking of trivia, do you know what the term annuity originates from? Drop your answers in the comments below, and let's continue with our final income-generating asset. Lastly, the 12th one we're going to delve into is crowdfunding real estate. This investment avenue has seen a rapid rise in popularity over the past decade, primarily because it provides a unique combination of high return potential and diversification. It's a strategy that allows you to pool your money with other investors to buy into larger real estate projects that you might not be able to afford on your own. The charm here is the ability to participate in high-value property investments without needing to manage the property yourself or having tons of money, making it a highly attractive option for investors seeking passive income. According to a report from Grandview Research, the global real estate crowdfunding market size was valued at $142 billion in 2022 and is expected to grow at a compound annual growth rate of 50.9% during the forecast period. This incredible growth is testament to the increasing investor confidence in this investment route. However, as promising as this asset seems, it's not without risks. The potential downsides include project failure or market downturns, which can affect returns. Hence, it is paramount to conduct thorough research and consider your risk tolerance before investing in crowdfunding real estate. Keep in mind, a well-informed investor is a successful investor. And there you have it, a comprehensive tour of the top 12 income-generating assets. Don't forget to check out our other videos, and thank you for watching.